Thank you to the experts here on the panel for coming today and joining us and giving us your guidance and expertise. Dr. Zimmerman, yes, I have a question for you regarding the HIT loans. And as we look, if you could expand a little bit more on the 3-year deferment period and how you think that will be important for smaller practices going forward, and if you have any thoughts or evidence on what you think will be the financial return when you implement that, and how you can use that then, of course, to repay the loan. I mean, do you think there'll be that savings that's going to be necessary with this 3-year deferment to be able to then repay the loans?
I think so, because if you look at most implementations, it takes about 6 to 12 months before the practice starts to get back up to the original level of productivity. So if you figure in a year of that decreased productivity getting back to baseline, and then beyond that starting to generate more revenue, whether it be through cost savings and decreased cost of transcription, ability to see more patients per day, increase efficiencies in the office, decrease staff costs. By that point, by the 2nd and 3rd year, you're starting to generate more income, which would be able to start to pay off the cost of the loan. So for that 3-year period, to have a free, a no-cost source of capital where you're not paying interest, I think that would be very beneficial for the practice.
So the 3-year time period you think is adequate?
I think so.
In terms of being able to get the returns that you need?
Yes.
Okay, thank you. Mr. Sabarsky, yes, I wanted to ask you if you could elaborate maybe on why you believe the conventional markets are not meeting the needs currently for early stage and high growth businesses as yours. What do you see as the biggest hurdle at this point?
Well, the biggest hurdle right now, beyond just the lack of, it's the question why the dollar is not there, even though the dollars are there for later stage investment. Mm-hmm. And this is a phenomenon that we in the biotechnology industry have seen for the better part of 20 years. We've also seen it, frankly, with pharmaceutical companies who would prefer to pay more for later stage products that have less risk. So on the curve of risk and return, at least the pharma companies have decided to pay more for less risk. I think the challenge right now, as I interface with venture capitals, and there's a panel coming up next, is the venture capitalists that I talk to seem to want to have the same type of return, but they're less willing to take the risk. And the challenge that I face is that folks on the angel investing side, the sort of high net worth individuals, friends and family, have a very limited ability to invest maybe single-digit millions, $2 to $4 million really at most. And traditionally, venture capital has picked up the slack until more mature private equity has then come in, and so there's a sort of stair step. It's interesting, as part of the financial crisis, this dynamic has been exacerbated, and I don't have great rationale to explain why venture capitalists have changed their models. I have a couple venture capitalists actually tell me that they're shifting their model to actually invest in public securities, so not even private securities. So that may be something that other panelists could speak to. It's a mystery to me why this is the case, but it's a continuation of a dynamic that we've observed for some time now, Congresswoman.
Thank you. I appreciate that. I yield back.